we are interested in the financial statements or the 990 form, not as a source of investigation of the past. We're not in a history class here, in financial history, but in order to see how we can use these figures for our planning for the future. Okay, so we're talking about risk management. That's the overall title, that's the goal. Risk management means how do I assess my current financial position and plan for the future based on that, so that I will be able to manage my risk. Okay. Now here we have an issue with the financial statement because they describe the past, which means that when I sit here, we have financial statements for 2016. So the balance sheet is for December 31st, 2016. When do I have it? Best case scenario will be May, June 2017. Okay, because it takes time to prepare the reports. It's not that you finish the year, you press a button and that's it. It takes a lot of time to prepare the reports. Sometimes the reports will be ready only towards the end of 2017. Now, when I'm in the second half of 2017, starting from the middle to the end, this is basically the time that I will have the reports, then my 2017 budget is already planned and more or less fixed. Half of it or 2/3 of it were already spent, and I don't have a lot of ability to change it. What I can change and what I'm planning now in the middle of 2017 is the budget for 2018. Okay? So I want to use financial data for the end of 2016 to plan for 2018. 2018 is still on the drawing board. I can still plan whatever I want with that. So in order to do that, I need to create an estimate of my financial position, not in the end of 2016, but in the end of 2017. Because my financial position in the end of 2017 will be the basis for my planning for 2018. Okay, just to translate it to simple terms, if I have a deficit in my operating reserve, maybe even in my working capital, then I will have to plan a budget for 2018 with less expenses than income. Probably I will have to do something with programs, close programs, decrease expenses. On the other hand, if I have operating reserve and I have a positive working capital, then it is possible to plan a budget with a deficit. If you remember, we saw in our example budgets that were planned with a deficit. And I mentioned in general that we can plan a budget with a deficit as long as we have enough reserve to cover these deficits from previous year. So I need to know what will be my reserve, at least have an estimate what will be my reserve at the end of 2017 to see how can I plan for 2018. So this is the basis of risk management. And if I look at my situation and I want to forecast my balance sheet for the end of the year, I find out that this is practically impossible. I mean, try to estimate your cash balance not a year from now, a week from now. It's very difficult, and all the other items are basically impossible. But we can have a mechanism for forecasting using something which I call the simplified balance sheet. Okay. In order to understand the simplified balance sheet, let's go back to our PDF. Okay, so here you have a link to a guide. It's not exactly an article, it's a guide in which I explain the basics of cash flow management in nonprofits. So we are not going to discuss that in details due to shortage in time. We need another semester for that. But the basic of the structure of the simplified balance sheet appear already in that guide, I think in section B or C, so you can find it there. But this is basically the same thing. I copied it from the guide. So in order to understand that, we have to look at the balance sheet. And we start with the basic balance sheet of a nonprofit, okay? And we look at the two sides that we've seen already. So we have the asset side, in which we have current assets, we have fixed assets, and we have financial investment. It is in different order. The financial investment will be in the middle, and the fixed asset will be at the bottom. But this is the structure of the asset side in the balance sheet. Again, just to remind you, so if we go to the balance sheet of the CGS, we have current assets, investment, and fixed assets. Okay, these are the three components. Then we go to the liability side. In the liability side, we have current liabilities and long-term liabilities. Let's see that. So we have here current liabilities and long-term debt, which is long-term liabilities. And then we have the unrestricted net assets, our internal savings. Now, unrestricted net assets, we have restricted net assets, which sometimes are divided to temporarily restricted, permanently restricted. It's not important in our case. We look at the total restricted net assets. And we have the two types of unrestricted net assets. The unrestricted net assets for activities, which is operating reserve, and the unrestricted net assets for fixed assets. Again, if we look at the table here of the net assets analysis, so you can see that we have the operating reserve, which is unrestricted net assets for program, the unrestricted net assets for fixed assets, and the two restricted type, okay, which we combine together here in the table. Okay, so this is how basically a balance sheet of every nonprofit looks like. And now we want to simplify that by doing 2 steps, 2.5 steps. So the first step is we want to eliminate the fixed assets. Why do we want to eliminate the fixed assets? Because they are irrelevant for our financial position. We saw that already. And it is clear also intuitively, because if we have a shortage of money, if we have a problem with our salaries, commitment to suppliers, fixed assets are not a feasible source. You can't sell the chairs and the computers and the desk in order to pay salary to your employees. First of all, it takes time to make these sales, but on top of that, if I'm going to sell the chairs and the desk and the computer of my employees, where exactly they're going to work after that? So fixed assets are not a source of funding, and we want to eliminate them. Okay. Now here, as you can see in the balance sheet, we have fixed assets on the asset side and unrestricted net assets that were used for fixed assets on the liability sides. And as you can see, and as I told you in the previous class, they are exactly the same. Okay, so we have fixed assets here in the net assets, 34.78, and here, this is the same number. Okay, and this part we want to eliminate. Now, the balance sheet is like an equation, which means assets equals liabilities by definition. So just to remind you some simple operations from basic algebra of the, 7th grade. If I subtract from both sides of the equation the same amount, the equation remains unchanged. Still, the left side will equal the right side. So what I do, I subtract fixed assets from here and fixed assets from here. Okay? Since it's exactly the same amount, it will not affect the equation. The equation will remain an equation. The simplified asset side will equal the simplified liability side. Okay, so what happens when I do that? So I'm left with, in the asset side, I'm left with current assets and financial investment. Fixed assets disappear. And in the liabilities, I remain with the same liabilities without the unrestricted net assets for fixed assets. So I remain with current and long-term liabilities, operating reserve, and restricted net assets, which, to remind you, it's commitment to donors. So that is stage number one. So is this clear until now? No questions. Okay. The next stage is that since the working capital is my measure for short-term stability, I want to present the working capital explicitly in my simplified balance sheet. Okay? So in order to do that, if you look at the balance sheet here, you can see that we have current assets on the asset side and current liabilities on the liabilities side. Now, what happens if I subtract current liabilities from both sides? Okay, again, it's an equation. I can subtract the same variable from both sides. So in the liability sides, current liabilities will disappear. Current liabilities minus current liabilities, 0. In the asset side, I will have current assets minus current liabilities. Now, my current assets minus current liabilities is exactly the working capital. That's the definition of working capital. So basically, I have here the simplified balance sheet, which is working capital plus financial investment equals long-term liabilities, unrestricted net assets or operating reserve, and restricted net assets. Or to translate it to very simple terms, I have my working capital and my financial investment. These are my financial assets. Okay, I have two types of assets, financial assets and fixed assets. So here I have my two financial assets, working capital and financial investment. Now, if I take off from these financial assets my commitments to banks, which is long-term liabilities, and my commitments to donors, which is the restricted net assets, I'm left with the operating reserve. So the difference between the financial assets, working capital plus financial investment, and the operating reserve is all my commitments to external parties, banks, bonds, whatever, and donors. Okay? And this is the reason we have a difference between the short-term measures, which is working capital and sometimes also financial investment, and the long-term measures is commitments that I have to other external parties. So we see that in a minute in the example, it will be clearer. But there is another smaller modification that I can do. Sometimes I want to present my working capital explicitly as a combination of cash and net working capital. Remember that working capital equals cash plus net working capital. And we saw that in the example that we just did. So I can, instead of working capital, write here the two components, cash and net working capital plus financial investment, and here it remains the same. So before I let you ask questions, this we can close. Let's see it in our Excel file. So we have here the simplified balance sheet. Now, from now on, once you enter the data from the 900 form to the file, you do not need to do any calculations. Everything is calculated here in the file. What you are asked to do is to understand the numbers by writing the verbal explanation. Some people find understanding more difficult to doing calculations, but what to do? So that is unlike or different from the first part of the semester. So let's see what we have here. This is the simplified balance sheet. We have the working capital, okay, 6.476. So we saw it already in the green part, 6.476. we can see here that the working capital has two components, cash and net working capital. Okay, so this is one thing. And we have the investment, which is taken directly from the balance sheet, from the data that you entered here. Okay, so this is the investment. Overall, we have financial assets of $3.34 million. Okay, now, in the sources of funding or liability side, we have the, let's start at the end. We have a negative operating reserve that we saw already in that table above here, which is called net assets analysis. We saw that the operating reserve is negative. Okay, so here we have to explain to ourselves or to understand how come we have such a significant amount of financial assets. And again, the significance is in relation to the size of the organization. So this is an organization with annual income of $10.5 million. And it has financial assets of 30% more than its annual income, which is a great situation. You know, you can rely on its assets even without any income for the next year. Now, these financial assets are broken down so that half, 6.5 million, is in working capital, which is completely liquid, and half is in investment, which we don't know how liquid it is. If it's tradable securities, it is liquid. If it's less tradable, maybe not, but it has a very positive short-term position. So how come from a very positive short-term position, we reached a negative long-term position? We have a deficit in the operating reserve. And the explanation is in the commitments to external party. So 618,000 are debt to banks. Now, again, to explain it intuitively, what happens when we take a loan from a bank? We take the loan, we have cash in our bank account. Then we have to repay the loan in the future. But in the present, we have an influx of cash to our bank account, which increases the working capital, but it does not change the operating reserve because it's not our money. Okay? So this is one thing. And the other thing, the more important thing, is that we have $13.6 million in restricted net assets. So again, what does it mean? What is this restricted net asset? It means that the organization received donations, designated donation, that it received these donations in 2015, 2016. We can see that in 2015, it had already restricted net assets of 10 million, which it received in the past. And these restricted net assets increased by 3.5 million in 2016. So this is income. This is money that came in to the organization. It is held in a bank account or receivable. So it increased the working capital. But again, it's not the organization's money. Okay? And based on these assets, the organization withdrew from its internal sources and went from positive internal saving or positive operating reserve to negative operating reserve. So the simplified balance sheet provides us with the kind of nutshell of what happens in the organization. We have a short-term position, which is very solid, but it is based on commitments to banks and to donors. So the question is whether we are solid for the next year depends very much on how much we have to pay to the banks, probably in a couple of years, but it depends on the timeline of the restricted net assets. How fast we have to spend this money. Is it a project for next year, or maybe it's a construction project for the next 5 years? That we don't know. But we do know that our long-term position depends on the timeline of our commitments to our donors. Okay?
So this is another reason why sometimes it's not good to take a donation.
Well, I wouldn't say.
Exactly
no, I wouldn't say it's not wise to take a donation. Look, the organization took the money because it presented projects to its donor. It's not that the donor came after the organization and said, take the money and give us project. It's the other way.
Like sometimes the donor drives the project and the organization sways to get the funding.
Okay, so that's a different issue.
But in that case,
it's not financial issue. Right. It's a goals issue, and that is, are you needs driven or donors driven? Exactly. Okay, that is a strategic issue for the organization to decide. But from the financial point of view, if you took a donation and you have income, that will improve your short-term position, always. What will it do to the problem here is not that the organization took the money. The problem here lies here in the flows side, which we will see. So what we see is that the organization, we'll see it later on when we have the full analysis, it overspent from its internal sources based on the fact that it had a lot of money in the short term. Okay, so the short term can create some kind of a money illusion. Now, it may be an educated decision due to the fact that they believe that they will be able to kind of replenish the deficit, get the money back. And it may be just an accident, which is usually the case, because financial management or financial planning in nonprofits is not very common. What I'm showing you here is not should be done, not necessarily what is done. Okay? All right. So this is the simplified balance sheet, and the simplified balance sheet will serve us, one, as a basis for analysis, which we will immediately do, and two, as a basis for forecast, because it is practically impossible to forecast a full balance sheet, but it is possible to create at least some kind of a simulation for the future simplified balance sheet. Because it's simplified, it makes it practical to create some kind of forecast or scenarios. Okay? All right. So from now on, we have a set of tables with verbal interpretation. And the tables are all calculated. Okay? They are all calculated automatically. What you are expected to do is to have the verbal interpretation. So I'm going to go over the verbal interpretation for the CJH. And next week, we don't have a class. Okay? And I believe that 2 weeks after that, that's Eid al-Adha, correct? Correct me if I'm wrong.
But I think that's on Thursday.
Yeah, well, we do have a class, but Muslim students from my other class told me that they are going to be at home also on Wednesday. So I don't know what's the situation with our Muslim friend here. So tell me, Ahmed, Amna, 2 weeks from now, are you going to be in Zoom, or are you going to be here, or are you going to celebrate? No comment. Anyway.
I can attend from Zoom.
Zoom. Okay. Yeah. All right. Anyway, I thought you were going to bring us the lamp here, Ahmed.
Sorry for that. Yeah.
Aside from, I was planning on barbecued lamb, but okay. I'm just.
Excuse me. So after 2 weeks, we have a class, right?
So after 2 weeks, we have a class, yes. And so yeah. For the next class, which is not next week, there is a holiday here and no class, so you will do the same thing that we will do here in class, we will do for the PHR, which means take the template and then write your verbal interpretation for the PHR. Okay, everything that we are going to do, we do here in class, you will do for 2 weeks from now for the PHR as an exercise to see that you got it right, and we will go over that 2 weeks from now. Okay, so let's see what is the issue. The first table shows us explicitly how much was invested in fixed assets. Now, just to go back a little bit, we saw the table of activities: income, program expenses, overhead, adjustments, depreciation, which is not an expense, but it appears in the statement of activities. But we haven't seen anywhere how much was invested in fixed assets. This does not appear explicitly in the 994. And although it does not appear, it is an important element in our analysis of the operating reserve, because if we have, even if we have a positive economic operating reserve, but we use it we spend it on fixed assets, it will decrease the operating reserve. And we have to pay for it, right? Money is fungible. The money doesn't care if it goes to program expenses or to a fixed asset. So here we have a table that calculates the investment in fixed assets. What do we see here? We see the beginning balance of 36.3 million. That is taken from here. Okay, 36.3. Then we see the ending balance here, 34.78. That we already saw here, fixed assets. Okay. Now, how did we get from 36.3 to 34.7? In general, we expect that the net fixed asset will be decreased because of depreciation. So if there is no investment in fixed assets, then we will have the fixed assets at the end of the period as fixed assets of the beginning of the period minus depreciation. Okay, so here we have the depreciation with a minus sign, and that is taken from here, from the figure that you entered with a minus sign. Hence the importance of the sign here, because if you mix the sign, then everything gets wrong. But on top of that, we have additional investment in fixed assets, and here the sign is plus, means that we invested, minus means that we divested. Divested meaning we sold fixed assets. So it can be either that or that. Okay? So here we can see that 3.63 minus 1.7 plus 224 will bring us to the 34.8, and this is calculated. What you are asked to do is to write the verbal comment. The investment is positive, which means there was an investment, but relatively small. The organization increased its fixed asset, but not significantly. Why do I write that? What is the significant or not significant? So we have to compare the investment to the size of the fixed assets. So if we have $36 million fixed assets and we invested $220,000, it's not very significant. It's not that we made a large increase. Yes, Gonzalo.
Is it advisable writing the answer to use percentages, not just saying the small?
Yeah, you can use percentages. You can.
But is it useful?
Well, you know, I would say that, right, not significant is enough, but maybe sometimes, let's say that the investment here was $2.2 million. So you may think maybe it is significant. Okay, so then you can write it's about increase of, I don't know, 10% or 8%. Okay, so the verbal comment does not have to be exactly as I've written, but you have to get it right. You have to get it right, whether there was a positive investment or the investment negative, and some kind of relation to the investment to the size of the fixed assets of the organization. All right? This is simple, right? Okay. Now, the next table shows us the connection between what we see in the statement of activities and what we see in the balance sheet. Okay? So just to remind you, the changes column in the balance sheet or simplified balance sheet basically reflects flows. Remember that I told you there are two kind of numbers in the financial statement. There are balances that are correct to usually the end of a period. Flows is what happened in between. So the flows in the balance sheet, they have to be connected to the statement of activity, which is also a statement of flows. Income and expenses are flows. Flows is what happened in a period of time. So income over a year is a flow. Expenses over a year is a flow. Spending on fixed assets, investment over a year is a flow. So this table shows us the connection between what happened in the balance sheet and what happened in the statement of activities. So let's have a look at it. So first of all, we have the surplus. So surplus or deficit, here it's a surplus, excluding depreciation. This is taken from here. And again, to remind you, what we saw in the 990 form is a small surplus of 90,000. But this surplus includes an expense of $1.7 million of depreciation, which is not a real expense. It's not something that we actually spend. It is calculated or an estimate of the reduction in value of the fixed asset. So if we want to look at our financial position, we have to take it out. Once we take it out by entering here the depreciation again with a negative sign, we get the actual surplus, which is much larger, 1.8 million. Okay, so if we take it as two steps backwards, when the organization presented the income and expenses to the accountant, it presented a surplus of $1.8 million. Then the accountant took that surplus, deduct from it depreciation, and reached the 90,000. Okay, and this is what is presented in the statement of activities. So the first thing that we have is this surplus. Okay. Now, then we have the investment in fixed assets. So we had a surplus, but of that surplus, we took 224,000, which we calculated here, and invested it in fixed assets. Now here the signs are opposite, okay? Because from the point of view of fixed assets, if we invest in fixed assets, we increase the fixed assets. But from the point of view of our financial position, cash, we decreased our cash. Okay, if you buy a computer, then you have, and let's say you pay, I don't know, $1,000, so you have a $1,000 computer as fixed assets, but minus $1,000 in your bank account because you have to pay for the computer. And that is something that we'll see later on, that in the asset side, the changes are opposite between the change in assets and the change in cash or in working capital. Okay, so here we have fixed assets with a minus. So altogether, if we look at our surplus, including the investment in fixed assets, something that we haven't seen in any of the financial statements, only in the analysis, we can see that we had a surplus of $1.6 million. All right? Now, how this surplus is reflected in the balance sheet. So the surplus in the financial statement and the investment in fixed assets has to be reflected as the changes in the restricted net assets and the internal saving. In order to understand that, let's look at the table here, okay, which is a scenario, a possible scenario for the breakdown of income and expenses between the restricted net assets and the unrestricted net assets, or the operating reserve. Why do I say possible scenario? Because in the 990 form, we don't have the exact breakdown. In the financial statement, we will have the exact breakdown, but for the purpose of explaining, it doesn't matter. The scenario is good enough. So in this scenario, first of all, we start by the opening balances. $1 million in the operating reserve. See, this is the figure. And $10 million, that was our opening balance in the restricted net assets. Now, in this scenario, our income, which the total income, as you recall, was 10.5 million, is broken down to two components. 7.4 million is unrestricted sources, okay? While 3.5 million is from restricted sources, okay? Now, if we look at our expenses, so here in this scenario, our full expenses, okay? So if you mark all the expenses, you can see here that we have, sorry. If we mark all the expenses excluding the depreciation, which is not an expense, we have an expenses of 9.114. So let's see how this is calculated. So we have expense plus adjustment minus the depreciation, and second, I missed something. So let's see how it's calculated. Okay, without the adjustment, right? Without the adjustment. So we have the adjustment are not very important here. I'll explain to you in a minute. So if you look at the expenses, we have this one plus this one minus the depreciation, and also minus whatever expenses we have on the restricted net asset side. Okay, so this is right now 0. And in terms of the income, why the adjustment is not included in the expenses? Because the adjustment, which you can see with the positive sign, is basically an income that appeared in the financial statement but does not appear in the 990 form because of different definitions of the tax authorities and the financial statement. So the total income is 10.9, and if we sum that for this one, okay, so you can see here below, if you mark these two lines, 7.4 and 3.5, and you go down all the way here, you see the sum, you see 10.9. So let me again reiterate that because I might have lost you. The income in this organization, which appears in the financial statement, not in the 990 form, is this income plus the adjustment. This is, you see here, 10.9. This income is broken down to 7.4 as unrestricted and 3.5 as restricted. All right? The expenses here in this scenario are fully allocated to the unrestricted. Again, it's not necessarily what happened. It may have been that some of the expenses were allocated to the restricted, but it's not important for our example. So expenses are allocated fully to the operating reserve, but we have to remember that these are the expenses without the depreciation. Okay, so we have to take out the depreciation. and this is 9.1. Then we have also investment, which is taken from the operating reserve of 224. Okay, so the overall amount that was spent from the operating reserve, okay, is 1.9 million. This is what we see here, 1.1 million, and this is what we see here, 1.9 million, which basically brought the operating reserve from a balance of million to a negative deficit of 907. I started with my 1 million, I overspent 1.9 million, and I have a minus 900. So this is the ending balance. So one component here in the change in the balance sheet is the delta. Delta stands for difference. You know, the Greek letter delta is the common mark of a difference. So the change or a change. So the change in operating reserve was 1.9 million, and we see it here. But we had additional 3.5 that were added to the restricted net assets. Okay, so that additional restricted net assets, not only that it covered this deficit, but it also added 1.6 million to the financial sources, and hence we have the equality between what we see in the statement of activities and what we see in the changes in balance sheets. So in general, the statement of activities reflects this one. This surplus reflects everything, unrestricted, restricted, and all the expenses. Then we have to take out the investment in fixed assets, and we have an overall surplus of 1.6 million. But this surplus is not actually ours. The only part which is ours is the part of the surplus, or in this case, the deficit that came from the operating reserve, from the unrestricted sources. And here we can see that we overspent in the unrestricted sources, so that we started with a positive operating reserve, but we ended with a negative operating reserve. But we were able to do that. Where did we take the money from? So we were able to do that due to the fact that our restricted net assets increased by $3.5 million. We received additional money which is restricted, which we haven't used in 2016, but we kind of withdrew from it. We took from it to cover the deficit. And this explains how come we can have a positive working capital versus a negative operating reserve. How come we improved our short-term position, but the long-term position became worse? We just used the restricted money for unrestricted purposes, either accidentally or on purpose, doesn't matter. The thing is that we have to fix it in the future, okay? Even if it's on purpose, which means, let's say you got a grant for construction and you know that you only start construction at the end of next year. So I can use the money in the meantime if I have some kind of shortage, but I have to replenish it. I have to put it back because I will have to do the construction eventually. Okay, so this is what we see here in this table. This is an important table. And based on that, we have the finance structure of the organization, which is presented, I think, here. Okay, so the finance structure, which basically presents the balances, says that cash plus net working capital, or basically the working capital plus investment, equals the sources of funding, which is the operating reserve, the RNA, and the long-term debt. Okay, this is exactly what we saw in the simplified balance sheet. Okay, this is the simplified balance sheet. This is what we see here, and this is what we see here, and we have to explain. So first of all, let's see how the structure looks like. So we have financial assets. Let's start with that. $6.8 million investment, we saw already. Okay? This one. Then we have $1.9 million in net working capital. Again, we saw that. Plus 4.55 in cash. We saw that. These two together, which is 6.476, is the working capital. So this is the side of the financial assets. This is financed by, again, it is exactly the simplified balance sheet, but transposed in 90 degrees. We have the main source of funding is the restricted net assets of 13.6. Then additional long-term debt of 618, but a deficit in the sources of funding of 907. So altogether, we get the same amount. Okay? So before going to the analysis, the verbal analysis, there is one thing that I want to add. That is to your question, Michelle, what should be a good operating reserve? We know that negative is not good, but how positive it should be for the organization to be considered stable. Okay, so we need a benchmark. Like we have in the working capital, we want to have a positive working capital, and we want to have a current ratio that is larger than 1, and the more significantly it's larger than 1 is better. But in the working capital, we have a more concrete benchmark. Now, again, this is not a law of physics, but in 2008, a think tank in the United States was asked to determine kind of boundaries for the operating reserve. Boundaries, I'll explain in a minute, but the boundaries that were determined are 25% at least of income, up to 50% of income. Now let's explain, let's translate the numbers to human language. What is 25% of income? It means 3 months of operation, okay? 25%, 3 months out of 12. So basically what this think tank determined is that for an organization to be considered stable, it needs to have operating reserve that covers 3 months of operation without income. Basically, you can see, I guess, the logic will be that in case there is no income at all, at least the organization have 3 months to kind of get organized. Even if it has to close altogether, 3 months are enough. Now, as for the upper limit, so here there is a difference. In the United States, you can have how much operating reserve as you want. It makes no difference. In Israel, there is a limit. If you have operating reserve, which is more than 100% of your income, which is higher than your income, you may lose your non-profit status. The tax authority may say, well, this is not exactly a non-profit, this is like a more... So, but this is a very rare situation in Israel. In the United States, I'm aware of several large organizations that have huge amount of operating reserve, but in Israel, it's a very rare situation. Usually, the limits are between 25 to 50. So if you exceed 50, it's not a big deal. You have to make sure not to exceed 100, but the 25% is considered as the minimum. So here what we have is we have the recommended level of operating reserve, which is calculated as income times 25%, income $2.5 million times 25% is $2.6 million. And here we have the gap. The gap is the difference between what we have, which is minus 900, what we want to achieve, which is 2.6, and you see that the gap is negative, which means that the organization, obviously it's below because it has a negative operating reserve, but even if it had a positive operating reserve, it could have been negative if it was below the $2.6 million. So the gap shows us what needs to be done in order to achieve the criteria of financial stability. Here we have to have a surplus of $3.5 million. Obviously, this gap in an organization that has income of $10.5 million it is not feasible to close a gap of $3.5 million, 35% of its income, in 1 year. Remember that closing the gap means that we have to have a surplus. We have to decrease our expenses. So this is basically the measure for our financial strategy or financial long-term planning, because we have to plan not only to get to a positive operating reserve, but if we want to achieve kind of, I would say, approval of stability, it's not a formal issue, but it became quite accepted, the 25% norm, then we have to create a plan, a long-term plan for a few years to close this gap, to gradually have surpluses until we close the gap and we reach the $2.6 million. Okay? Now, so this is all calculated. What is your part? Your part is to provide the verbal explanation. So let's look at the verbal explanation, see what we have here. The organization has a significant amount of financial assets, 3.3 million, more than its total income. The reason that I use the adjective significant is because the financial assets are larger than the annual income, which in the short term is a very good situation, okay? Meaning you have enough money in the bank, basically after all the deductions, to cover all your expenses, even if you don't have an income at all, okay? So this is line number 1, 3.3 million is taken from here, okay? Total financial assets. Now we look at the analysis of the financial assets to see in terms of liquidity how much we have, because the investment may be illiquid or partly illiquid. So we can see that the cash balances of 4.6 million are basically 1/3 of the financial assets. So 1/3 is in actual cash, can be used immediately. Okay, 1/3. Again, in terms of an income of $10 million, basically 45% of my income is already covered in cash that I have at the beginning of the period. And working capital, which is 6.47, we don't see working capital here explicitly, we see it here. Okay, that's the sum of net working capital and cash. Working capital is almost 50% of the financial assets. And again, the working capital is second to cash in terms of liquidity. In order for the working capital to become cash, I have to collect the debts to me and to pay my debts, and I have additional cash that will increase my cash balances to the level of the working capital. So the working capital, 6.5, is almost 50% of the financial money. Okay, and that means that there is a significant amount of liquid assets to cover possible shortfalls. Okay, it's way beyond many organizations have to begin with. Like 6.5, 65% of the income is covered already by their working capital at the beginning of the year. So that is the full description of the financial asset side. Now let's see the sources of funding. So we start with the large number, which can vary. The main source of funding is the restricted net assets, 13.6. Now note that the 13.6 restricted net assets is more than our financial assets. Now the 13.6 reflects a commitment. So we have a commitment to our donors, which is more than the money that we have, or all the financial assets that we have. So that points to a possible issue in the long term. Now, how this is possible? It's possible because the operating reserve is negative. So there is an accumulated deficit of 907,000 in our operating reserve. And again, it shows us what happened in this organization. We kind of withdrew resources from the restricted and use it for our own purposes, for the unrestricted. So we have kind of a debt, something that we have to repay our donors. And there is also a small debt of 618, again, small compared to the size of these sources of funding. So 618 compared to 3.3 is relatively small. Okay. Now, the gap between the actual and recommended operating reserve is significant. We saw that $3.5 million gap is significant. Significant relates to, again, to the income of the organization. Okay, always remember that in a non-profit, to create a profit or to create a surplus is difficult, because when you reduce income, you basically hurt the mission of the organization. The mission of the organization is not to make money, it's to spend money on its programs. Okay? Sometimes we have to do it to balance between the mission and the financial strategy. But we always have to remember that it's not in the for-profit world, it's a win-win. You cut expenses, you increase your profits, everybody's happy except for the employees that were dismissed. But in the non-profits, it's a win-lose. You decrease expenses, you decrease the program, you hurt your mission. Okay? So we have a gap which is significant. Now, the negative operating reserve represents vulnerability in the long term. Okay, that we understand. In order to assess this vulnerability, we have to look at a figure that we don't have here, but we have to realize that we are dependent on the timeline of the restricted net assets, which means the commitments that are involved in this $13.6 million can be commitments for several years from now, or can be commitments to next year. If these are commitments to next year, then we have a serious problem, because then we have these negatives that we have to replenish it immediately. If these are commitments for more years, like it's a construction project or renovation project, then we have more time to improve our long-term financial situation. Okay? So this is the verbal part, and this is basically what I ask you to do for the PHR for 2 weeks from now. So you write this interpretation, and you write also this interpretation or comments on the final structure. And again, you can use the same order so that you don't have to invent anything. It is very orderly. Here it's according to the lines or columns, and here it's according to size. So the main source and then the rest. And obviously, if we have a positive or a negative, that can change, but the structure remains the same. Okay? Is this clear?
It's the same exercise that we filled from the 994, right?
It's the same. What you're asked to do is to take the template file that you did for PHR. This should be empty. You look at the figures and you write your interpretation. Okay? So you have a structure of the interpretation, but obviously the numbers and the signs and will be different. Okay? And again, this is a template for any organization. I mean, I had a student a few years ago that once we learned that, the class after that, she came to me and said, I did it for my own organization and suddenly I discovered things that I didn't know, which probably will be the case. Okay, now, the next thing we want to do is to look at the changes, okay? So we want to look at the changes in the financial assets. Now, why do we want to do that? The reason is that, and again, the reason that we are investing that amount of time in analyzing the financial statement is that now we look at the end of 2016, compare it to the end of 2015. We have two balance sheets. We look at the changes, we analyze them. But the next step will be, we want to make a kind of forecast or estimate for the end of 2017. For that, we will use the expected changes. We'll see 2 weeks from now how we get these figures. And we will add the expected changes to the 2016 to reach 2017. So we want to understand the connection between the balance sheet and the changes in order to create the forecast as the next step. Okay, so always remember that we do this heavy lifting of analysis, not for the sake of the analysis, which is history, but for the sake of understanding the relationship so that we can create a forecast. So let's just look at the numbers, and we'll talk about the interpretation maybe next week, we'll see. So what are the changes in the financial assets? We have, I think, the relationship here. Before that, okay, so we'll do the relationship probably next week. Before that, I want to show you two more things that I kind of skipped. That's why I have this PDF to remind me. It's not only for you, it's also for me. So first of all, regarding the financial or the finance structure of an organization, so this is a kind of general format of an organization which shows you different relationship between the operating reserve and the other commitments, long-term debt and restricted net asset. So first of all, if we have a negative financial assets, a deficit in the financial assets, which is possible, then we will always have a negative operating reserve, which means that it is possible short-term deficit does not allow for the long term is always equal or less than the short term. Okay? The long term cannot exceed the short term. So if the short term is negative, then the long term will be negative too. However, it is possible that the short term will be positive and the long term will be negative, which we saw in this example. So the best case, obviously, is positive and positive. This is what we want to be, in a positive short term and positive long term. But there are two situations in which the short term can be positive and the long term can be negative, and obviously there can be a mixture of the two, as we see in our example. So positive short term, negative operating reserve, and the difference is covered by debt, long-term debt. That is one situation. So we have a deficit in our operating reserve, but we took loans from the banks. The loan brought money to our bank account, increased the working capital. So we have a positive short-term, but negative long-term. And the other example, which is very apparent here, is that we have a positive, a short-term, negative long-term, and the difference is covered by restricted net assets, commitment to donors, influx of money that came from donors for future project. And this, what we saw here in this example, is a combination of the two. So we have a positive short-term, very large amount of financial assets, negative operating reserve, and we have both long-term debt and restricted net assets. Okay, so this is something that it's important to understand, that short-term, if the short-term is negative, the long-term is for sure negative, maybe even more negative. It cannot exceed the short-term. But we can have a positive short-term and negative long-term due to long-term commitments. This is number one. And number two is that I created kind of qualitative ranking of financial position, which is composed of three measures. One is the short-term financial assets, two is the long-term operating reserve, and three is the change in operating reserve. Did we improve our situation or got it worse? And it is reflected in 6 numbers with colors. So you can see the worst is number one, negative, negative, and a decrease in the operating reserve. Okay? And then we have negative, negative, and positive, which means we have a negative short-term and negative operating reserve, but at least we improve the operating reserve. There is kind of a process of improvement. Then we have positive short-term, negative operating reserve, but became more negative. And now we start to move to the more green part, which is positive, negative, and positive, which means we have positive short-term, negative long-term, but we improved our situation. And the two green ones are positive and positive with a decrease in operating reserve and positive with an increase. So you can see that the CJH rank is 3. We have positive short-term, negative operating reserve, and a decrease in operating reserve. And when you do the analysis of PHR, look at the results of the PHR and try to put it in this scale where it stands in terms of short-term, long-term, and change.